We're live. The entire nation has been enthralled by the midterms, but we elect to focus on the real red wave. Dun, dun, dun. Home prices drop and homeowners lose equity as buyers abstain from buying, and buyer sentiment polls at historic lows. Inflation ticks higher with rising interest rates, and real estate companies lose billions in politic with media and shareholders. Is this the final count to another housing crash? Find out on This Week in Real Estate. Yeah, what's up, everybody? Thank you for joining us live. We appreciate you guys being here. We are going to focus on all these actual issues. So no matter what you saw in the news last night, no matter if your team won or lost, we all know that housing impacts everybody. So that's really going to be our focus of the show. So thanks for joining us. My name's Ray. Say hi, Dan.
Hi, Dan.
And that's Dan. Both of us are real estate agents. I happen to be in Arkansas, and Dan is all the way around the world, depending on which way you go, to Los Angeles. So
I happen to be in LA.
Happy to be in LA? Are you sure? I thought there was a mass exodus. Everybody was leaving LA, right? Isn't that the
That's
thing?
why I'm happy.
Get out and stay out. What is that?
Well, Olivier says it looks like my shirt has a pair of butt cheeks on it.
Oh, I can see that. Yeah, it looks like somebody sat down in paint.
If we just do that, that's what it is, really. But if you know that band right there, then you're my friend. If you don't know that band, you need to know that band. I saw them live last Wednesday. Yeah, about a week ago. Yeah. And it was...
Everybody loves that band.
Absolutely amazing.
One of my favorite drummers. Just kidding. I have no idea who it is.
I'll give you a hint. He's a drummer and he also sings.
Oh, yeah? Oh, okay.
Yeah. And they're only a two-piece. They're called Death from Above 1979.
Nice. And
they absolutely rocked live. It was at a really cool place out in... It's a place called Pappy and Harriet's. Little tiny town. You literally take a road that goes into the mountains, I've sold some land up there. It literally goes and you just like, oh, cool, there's Pappy and Harriet's. And they're a relatively good sized band, and it was outside and it was like 40 degrees. It was a fantastic experience. If you're ever in California and have the opportunity to see a show at Pappy and Harriet's, you have to go.
There you go. This segment brought to you by Pappy and Harriet's.
Pappy and Harriet's.
Well, thanks everybody for joining us. We're broadcasting in 4 different places right now. We're on Clubhouse. So if you're joining us on Clubhouse, be sure you click the green house at the very top. That is the largest real estate networking club in the world of Clubhouse. So I think we're like around 40 or 50,000 members, something crazy like that, right?
I don't even know where the house is anymore. I don't see it.
It's up at it may be different on Droid, but it's up at the top there. Let's see, 41,000 members.
Dude, when we started, it was at 27 or something. That's crazy.
Yeah, I think, most of that could be attributed to us.
I would say so. Yeah. So Clubhouse and real estate networking. You're welcome.
Of course. But we are also broadcasting on Facebook. You could join us there and make a comment that we could display your comment and talk about you or your comment, just like we can if you're watching over on YouTube. So Matt LaMarche was first. So he says, hi, beat you all again. Just call me the big red wave. So thanks for joining us over there. Melissa Mara is over there too. She's also listening in Clubhouse. And then Olivier, he is also listening in Clubhouse and watching on YouTube. So they're getting the full audio experience. We have a ton to talk about, so we're going to go pretty quickly. But Dan, before we get into all this stuff, would you tell people what this show is actually all about?
You know what? I would love to. Now, when Ray and I met here on the interwebs, trolling real estate agents, some of the trolls are still going. They just don't know it. And it's been 6 years.
Emotional damage.
We were inflicting emotional damage before it was even thing. And
it was cool.
A lot of times we ended up on the same sub thread, kind of like, this guy's good. And we kind of found common ground from there. And at the time, I'm obviously a bearded man of real estate. And at the time I had an idea for a show called The Bearded Man of Real Estate, which is now This Week in Real Estate, because for some reason, bearded men of real estate didn't make sense to people.
They didn't know what we did. It's weird.
You're real estate agents that talk about beards? Yeah, sure. Whatever.
Mm-hmm.
I mean, there was a long time where Ray would get more questions. He wouldn't get any questions about the show, but he would get questions about being bearded.
Bearded. Yeah.
And we're like,
that actually happened.
But anyway, I obviously noticed that he's a beautifully bearded man, but I also noticed something about Ray that was very interesting.
What was that, Dan?
He's never seen me play drums. Never.
I have not. Only in jest. You had
You actually have
video or something, or was it on Marco Polo?
There you go.
There
you go.
Yes. Was it?
Yep.
Man, that was a long time ago.
That was a long time ago. So we had split off from our group and made our own little small group. And then we made an even smaller group on an app called Marco Polo, which was like a walkie-talkie app, kind of.
Yeah, it's still around. Krista Nielsen actually sent me a couple of Marco Polos. People still use it.
It was really fun, and I would actually play drums on there. I bring it up because I'm a drummer. This dude's a drummer, singer, anyway. But I digress. And yes, I noticed that Ray is a beautifully bearded man, but I also noticed that he loves giving value up front to not only his clients, but just to humans in general.
And one of the ways we believe in giving value is to know what in the world is going on so that you can consult with your clients and give them hopefully the best possible advice with one of their largest real estate investments. But I do want to clarify something. We know you're a drummer. We know you like drummers, but I don't know if you know this, Dan, but I am actually a drummer as well.
How long have you been a drummer, Ray?
Well, so when did Guitar Hero come out? World Tour?
World Tour was 2008. I actually worked on that video game.
That is the game that made me a drummer, because I got to expert level and to where I could just like drum with the music. And,
okay.
So you may not know, Dan, I'm an actual expert level drummer who is headed to legacy
in Guitar Hero.
Well, I mean, they're pads. Like, okay, so if you have a guy that uses an electronic drum kit and hits pads, is he a drummer? Yeah, he's a drummer.
Yeah, it's very, very different because I actually, when I started, I worked on the game. I actually couldn't play Guitar Hero drums when it first came out. Totally. So different.
I was actually a better drummer than you for a while. For
a while, you were much better than me until I mastered it.
Yeah.
Yeah, and Matt Malarsh is actually a tromboner. Did I put the emphasis on the wrong part of the word?
Yep.
Oops. He's a tromboner.
All right, you ready to give me these headlines?
Dude, we have a ton today, and it is scary, Ray. I'm going to be honest with you. It's a little scary.
It's a little worrying. Let's go. One of the things we love about the show is the thumbnails. And if you missed the thumbnail today, you should note. There it is. It's Dan's happy face with a blue tie and my surprised face with a red tie. And my podium is on fire while his is not. and we have a giant red background with an arrow. There's like an arrow going down to show. Yeah.
And I'm obviously happy about everything going down.
Well, you're happy about one part, right? But I mean,
but wait,
you should both know
trivia, and we're not gonna. I don't know if Ray's about to give away the answer. We're not gonna give away the answer, Ray.
We're not gonna say.
But you guys need to guess in the comments who's. And I will give you this one hint. It's one person's body.
Both of our bodies are the same person.
Whose heads are, whose body are our heads on?
Right. It's the same person.
It's a tough sentence.
Different outfit. Whose body are our heads on?
The blue and the red was calculated. The fire was
you like good. Well, so I put the fire as an homage to Christina M. Smallhorn. I don't know if she's listening already today.
You have to have fire in your thumbnails, guys.
Yeah, you gotta have fire in the thumbnails somewhere.
If you want to get tens of views like we do, you have to have fire in your thumbnails. Matt, no, incorrect. Keep guessing though, peeps. Keep guessing. It increases our engagement. So keep guessing.
Let's just let the cat out of the bag. Well, Dan, do you know what else is on fire?
Yeah.
Interest rates.
Usually that's said as a good thing, and this isn't a good thing.
Not a good thing. And weekly mortgage demand flattens as interest rates climb higher. So we have a culmination of headlines all about mortgage demand. I saw another real estate agent who I thought was kind of in the know, but he was talking about how mortgage applications plummet. So I don't know what he's reading, but weekly mortgage demand flattened as interest rates climb higher. So mortgage rates rose again throwing even more cold water on demand from both current homeowners and potential home buyers. Weekly application volume fell. Hold on to your seats, folks. 0.1% last week, previous week, according to Mortgage Bankers Association.
That's tough.
The average contract rate for a 30-year fixed mortgage was 647 or less, increased 7.14% from 7.06%.
Hey, and we don't have a story on it this week, but I was looking through just rates and things, and ARMs are gaining more popularity, and they're pretty good right now.
I've always been a fan of ARMs.
No,
that's why I like muscle
guns,
shirts.
Ray. Those are guns.
Well, I have the right to bear arms.
And those are actually bare arms.
So let's see. This quote is from Joel Kahn, Mortgage Bankers Association Deputy Chief Economist. Mortgage rates ended higher last week following the news that the Federal Reserve will not continue raising short-term rates to combat inflation. The 30-year fixed rate remained above 7% for the third consecutive week, which increases for most loan types. Refi demand, which has been crushed by this situation, fell another 4%. It was down 87% compared to last year.
Oof.
Mortgage applications to purchase a home increased 1% for the week.
Okay, we predicted that. Remember, because they went down a little. Remember, mortgage rates went down a little bit last week. We did predict that.
Yes.
And how much again?
1%.
Okay. I mean,
yeah. What I love about the headline is it says weekly mortgage demand flattens. Okay. So normally, if purchase applications go down 0.5%, the headline is purchase applications plummet. Or buyers, the number of buyers who want to buy a home right now plummet, that type of thing. Yeah. But it's up 1% for the week, and it's like, it's flat.
Yeah,
that's pretty flat.
Yeah.
It's still 41% lower from a year ago, which that is interesting. It's close to a 7-year low, but 41%. I mean, we've been having like higher numbers than that. So that's
especially compared to the refi, which is 87% lower than a year ago. That's a big number. We cannot deny that one. We cannot say that one is flat.
Right. In between stories here, we have a couple of guesses. Matt Lamar says Biden. He thinks our bodies are Biden. Maybe I should put it back up. I'm going to add it to the stream as we analyze.
Now, I would agree
look at
with
those hands. Those are pretty smooth hands for an elder man.
Right. And if it looked like we were on the body of the Crypt Keeper from, remember that show?
That would be closer.
Remember that show?
Yes.
Yeah, if it looked like we were on that body, then maybe, but no, the hands are way too smooth.
Matt also clarifies that the real estate group on Clubhouse is up to 47,000 members now. Facebook user says that they like YouTube more than Facebook. Thank you, Facebook user. And Matt Lamar says not here either. He's over on LinkedIn. So he's everywhere. He's got the cliff for the week.
Literally
congratulations, Matt Lamar.
He's the GOAT. He's the GOAT cliff.
Melissa Mara says Trump. She thinks we are on Trump's body. And
that would be a much wider tie and much looser, much more loosely tied if that were Trump.
I feel like the skin tone would have been a little more orange and maybe a better match for you. Now, I do like how
maybe it's offset by the red and my red, maybe, but no.
Could be. There's so that doesn't happen unless you intentionally do it. So I have to admit that there has been some editing because I can't just put a body on a red background and not adjust lighting and concepts and things like that to make it actually look like it fits. Yeah. So there was some adjustment to that, but don't let that throw.
But it's not Trump. And then Matt has another guess, Chuck Schumer. No, it's not.
Where's Chuck Schumer? I missed that one. Yep.
Not Trump.
Yeah, not Chuck Schumer either.
Yeah.
So keep guessing.
Yeah, surgery. Keep it up.
So we do have another article kind of about the same thing. It's from NAR, but they just had a slightly different take on it. So they said mortgage rates slip after Fed hike, but what's next? And in the article, they talk a little bit about the increasing in purchase applications by 1% and that kind of thing. Let's see, even with the Federal Reserve raising short-term Fed funds rate by another large amount, long-term interest rates look to move only slightly. Warren June, chief economist for the National Association of Realtors, the mortgage market has already priced in the latest move. And because of that, it sounds like some buyers are just kind of getting used to the rate and still, applying to buy a home. They still got to move. People change jobs, people change situations, people retire.
It's kind of what we've said, right, Ray? Like, yes, they're going to go up. Yes, they're going to go up. But at some point, they're going to kind of level and maybe go back down. We got to stay tuned for our prediction show in a couple weeks. But they're just going to get used to them. They were always in the 4s, kind of 5s, right, for a long time. And that was just what it is. Now they're going to go up and they're going to kind of settle. And buyers will just adjust. And people, like Ray was about to say, they have to buy and they have to sell.
Yeah. So then kind of in the same vein, these are all, I guess my voice just cracked like a teenager. These are all kind of the same thing. So I'm not going to make it a different. Purchase applications tick higher despite growing costs. This is from Mortgage News Daily. The Mortgage Bankers Association, MBA, reports another decline of overall mortgage application volume during the week of November 4th. Applications to purchase a mortgage did increase slightly, reversing a 6-week downhill slide. Now, keep in mind, Mortgage News Daily is the outfit that always puts kind of at the end, in the future, it could go down or it could go up.
Yeah, they never commit to what they're saying.
They do not.
We have a comment from Julie Mozina over on Clubhouse about the market right now. First-time buyers still don't want to rent, and that accounts for 40% of the market. It's a very good point.
First-time buyers, she says, don't want to rent. So you're saying that first-time buyers want to buy?
First-time buyers, they're not first-time renters. They're first-time buyers. They want to buy.
Okay. So if that's the case, let me find... We have an article about this actually today, and I'm having trouble locating it. We have a lot of articles today. And maybe this next one here. Let me check. That one's about home buyer sentiment. Nope, we'll get there. It's one of the research articles from NAR. Okay, here it is. And then
before you move on, there's another guess by Malarsh. Stacey Abrams, no.
Nope.
And then there's one more. Then there's one more.
What? Oh wait, he says DeSantos. All right, let's look. Could it be?
Could it be
DeSantos? Ding ding ding, winner chicken dinner. I don't have we had so many wrong answers that I took that off of my soundboard. I don't have any kind of good.
Just do the trombone one anyway.
Well, I have this one. Good job, Matt.
There you go. He's a tromboner.
You got the DeSantos. We're both on DeSantos's body. So
yeah,
very good. Impressive, Matt. Impressive that you pay that close attention to your
politician. I had feelings about, Ray. I did have feelings about that.
Yeah, Matt. Dan was excited, as you know.
But I love you DeSantos so much, Ray. I love you very much. That's all I'm going to say.
Dan's a man of the people. Okay, so let's go let's go into detail about what Julie was saying. First time home buyers. Let's talk about them. So there's 2 articles on the realtors thing. One is talking about 11 takeaways from the 2022 profile of home buyers and sellers. And the other one says the title of the article is, and this is why I want your reaction, Julie. First-time home buyers are vanishing from the market. What does that mean?
Vanishing.
Why are they? Where are they going?
They're paying overtly high rents right now, is what that's saying apparently.
Yeah, well, they're not buying. So if they're fed up and don't want to rent, what are they doing? So let's first look at the 11 takeaways. We're not going to go through every single takeaway. But let's go through the 11 takeaways from the 2022 profile of home buyers and sellers. Why are you laughing? What am I missing in the comments?
DeSantis. Is it DeSantis or DeSantos?
DeSantis. Mm-hmm.
2024. Yeah. Make America Florida.
Make America Florida again. MAFA.
MAFA. But you can't say again. It's never been Florida.
I guess so. It'd just be MAF.
It's just MAF.
Mm-hmm. Or you could just call him an MFer. No, I like it, but Dan would like that joke. Okay, so let's get back to the article. First time home buyers dropped to an all-time low of 26% from 34% just a year ago. There's good charts on this, so I'm going to share it so you guys can see it. I'll add it to the stream there. Bam. right. So first-time home buyers among primary residence buyers. Back in 2010, just for reference, they were 50%. Back in 2006, it was right about the 34% mark, which is what we just came off of, 34%. 26% is actually the lowest on record since 1981, which looks like when they first started tracking.
But
so
still,
it's 44% in 81, went down to 30 and then up. And then it's just kind of been tracking up and down a little bit. But 26% is the lowest on record.
But still, though, isn't that a pretty, I mean, that's a 1/4 of the market? Of the
1/4 of the
buyer
market,
pool?
but that, I mean,
Isn't that big?
not historically speaking. It's usually
Right, but
more.
still, one group of people makes up 1/4 of the entire buyer's pool.
What's this new positive blue spin you got over here?
What do you mean new? I'm always positive, even though everything is horrible right now.
I'm positive it's horrible, Dan.
Yeah, I'm positively down on this market.
The age of first time and repeat buyers hits all-time highs, which that's to be expected as millennials settle down slower and slower. Some other interesting stuff from the report: small towns and rural areas see a migration flow. The distance between homes purchased and the previous residence is up to 50 miles. Now, if you're just listening to the audio, you're thinking, okay, well, that's not significant.
But
For
look at the
context,
chart.
it was 15% or 15 miles.
Whoa.
15 miles was the previous high on this chart that's been tracked since 1989. So it went from 15 miles to 50 miles.
It's like a spike too. If you see the actual graph,
It's a huge spike.
now that's got to be obviously affordability, right? You know, if parents live in or around San Francisco or Los Angeles, like, okay, I'm a first time buyer, I cannot afford this, and
Right.
so I'm gonna move out. I'm gonna go at least 50, or maybe it's I just want to, you know, get out of California and be part of this mass exodus.
Melissa Mara says mom's basement. Well,
That's not
that was the
50
previous
miles away.
residence. Well, maybe, but there was a report from the National Association of Home Builders that less and less people are actually living with their parents. But 50 miles this jump is absolutely enormous compared. So,
Crazy to look at. Yeah.
and they're not talking about first time home buyers. This is how far a buyer moved from it was all-time high of 50 miles. It had been steady between 10 and 15 miles. So this is in contradiction to some of the earlier reports from Zillow that predicted people were moving just outside of their current zip code, that people had been staying kind of in the same zip code for years, and now they're going just outside the zip code. They're going way outside the zip code. That's a huge migration push.
Yeah. Do you think this is this a laggy number, or is this very current? Because remember when the Rona was happening, people were moving out into the farther areas, the more rural areas, to get a little more for their money, and they could work from home. Do you think this is a kind of how do you say that, a lagging indicator of that?
Yeah. One of the migration trends that gets tracked is using tax records. However, it's about 2 years behind in this specific. Now, I think they're using something that's different.
Yeah.
About 2 years behind on the How Money Walks website. So what's interesting is if you explore the data on the How Money Walks website, you're now going to see migration data that was from the Pandy. And so let me go to that real quick. I'll show you guys what that looks like. But this was 2 years ago. So you can see a net loss of all the northeastern states in California. Louisiana even lost some areas. And then these other areas have huge gains. But again, the data in some of these places could be over 2 years old, or around 2 years old.
Oh, not my gains. Oh, sorry.
Not your gains, Dan.
Oh, sorry.
Okay, so anyway, people are moving out.
Dude.
Buyers who financed their home to purchase, the repeat buyers, it dropped to 73%. The first-time home buyers increased to 97%.
Is that the difference between the red and the blue?
No, that's the blue line is the first-time buyers. The orangish red line is the repeat buyers. So you can see repeat buyers use more cash.
Okay, I see what you're saying. Yeah, okay, good.
Mm-hmm. Tenure in a home before selling is at an all-time high of 10 years. That's wild. I remember back when it was 6 years or less. And for a long time, it seemed like people were moving every 3 to 5 years. Now it's at a high of 10 years.
These charts just look totally made up. Like, why is that one just flat forever?
Just flat.
It just
the
stayed
median
the same.
expected buyer tenure. So this people say like, how long are you going to stay in the home? I'm going to stay there for 15 years. Now it's up to 18 years. But what they actually do is move every 10.
Yeah, forget the red wave. The silver wave is coming.
Silver
people.
wave.
It's coming.
Buyers are diversifying where they're putting their down payment. Okay. Prior living arrangement. This is the moving out of mom's basement stuff. How the seller sold the home. Let's see. Agent assisted was 86%. All for sale by owner was up to 10%, which is a recent high. It hasn't been that high since 2006. All right. So interesting report. That is from the National Association of Realtors on their website. You can find it at magazine.realtor. And then the other article I wanted to point out, which is kind of what Julie Mazzino was saying, which I would love for you to come up and talk about it, Julie, is the disappearance of the first-time home buyer. And they use some of the same data that we just talked about. But here's a quote from Jessica Lantz, NAR's Vice President of Demographics and Behavioral Insights. She says it's not so surprising that the share of first-time buyers sank to the lowest level ever recorded, given the housing market's combination of historically low inventory, persistently high home prices, and rapidly escalated interest rates. Yeah, that makes sense. But there's the chart, same chart we saw, just a bar graph.
Right. That one's a little more realistic looking. It's just not so flat.
Yeah. First-time buyers comprised just 26% of all buyers in 2022, down from 34% the year before. That's also nearly half of the 50% peak. But what's, you had a surge. It wasn't a peak, but you did have a bit of a surge last year with 34% of the home buyers being first-time home buyers, taking advantage of low rates. So it only makes sense that in a high rate environment with low affordability, you're going to have a pullback on that. But it's been more than most people anticipated, I think. Christina Smallhorn's joined us. What's up? She says, "Hey, fellas."
And
she wants to cut her hair like yours.
Yeah, she wants to.
Well, she should.
You want to have a mohawk like I do, a mullet mohawk, dude?
Yes.
I'm literally the only one on the planet that has this haircut. But please join me. I would love to start a thing.
She brings up a good point. She says the graph is on the internet, so it must be true. That's true. Yeah. Yeah.
And that's why I believe it.
That's right. Oh, I forgot my little transition in that, didn't I? Darned.
I don't know.
Okay, but Julie's up. Okay, Julie, tell me, what are you thinking about this first-time home buyers?
And where's she at? She's in Iowa, right?
I'm in Iowa. I've been through, because I was around before 2008, after 2008, and then here. And for me, around here, we still have large builders indicator for me, and they're still creating a lot of inventory for the first time buyer. And honestly, when rates are going to go up, rents are going to go up. Yeah. So to me, it just makes more sense. Why would you still want to pay rent? Why wouldn't you want to own? I realize the demand is, the housing demand there's a housing shortage because I'm not moving. I have a low rate. There's more people just like me. I'm not silver yet, but that's kind of where I'm at. And for people that want to sustain in a business, I just say, turn your eyes to first time buyers, keep your head above water. Obviously relationships, keeping relations. I know that's not the topic, but I just think that the first time buyers are just going to kind of, keep things moving, so to speak. If we can keep them buying, then maybe we'll get more. I don't know.
So do you think there's going to be, it was down to 24% last year. Do you think there's going to be a surge of first-time home buyers coming back to the market as soon as rates kind of chill? Or do you think they're going to do it despite rates?
Well, I mean, to me, if history tells me anything, I don't think it's really going to change too much to people right now. I mean, this isn't a big time for people to buy anyway, this time of year. I mean, we're at the end of the year. And yeah, I think some people are afraid of the rates just because of the news and that we didn't have the internet in 2008. Well, we didn't have Facebook. We didn't have, so there wasn't as much fear and, oh my God, the Fed and every realtor, on there saying, oh, the market's not crashing. Oh, it's this. Oh, it's that. You didn't have all those factors back then either. So I remember doing FHA is going to make a comeback. They're, the average, just think about that. Two college graduates coming out of college this year, what's the average income? I don't know. I'm going to pull it out of the air. Let's say 40,000 each.
We can get a number crunch on that while you're talking.
That's still bringing them into the market. They're still going to be able to, they're still going to want to buy. They're not going to want to rent, especially if.
Well, you said two, right? So you're also
like
assuming
husband and wife, like a husband and wife. Yeah.
Girlfriend, they ain't husband and wife in these days until they're almost 40.
Well, you got a point there. You definitely have a point there. I have two of them.
Yeah, see?
There's also boyfriend
you're right,
and boyfriend.
You're right. I stand corrected. I felt, couple. Well,
but it's
rephrase that.
You're real close though. The median starting salary for a college grad is $47,000. So you're like right on the head.
And then you got to remember they have $300,000 in debt from college. So
yeah, true.
That's a thing.
Yeah, but I don't think college. I don't know. Do those still count against your pre-qualification? Didn't the government do something about that?
It doesn't, but it does count towards your affordability. Right. So if you're paying $200 or $300 a month towards debt service of a college thing, then that's $200 or $300 that you can't put towards your home to get a bigger home.
Yeah.
So
I'm just saying it's a better fishing pool. It's either at the beginning or in the silver. It's like those are the two. Those are my bookends. That's where I'm focusing. And client retention. I mean, that's what's going to keep us in business for those of us that are staying.
And then
for those of us that are staying, you said, yeah. Okay, you're throwing some shade. I picked up on. That's so good. For those of us that are staying,
Julie, on Clubhouse in the comments, you made a point about home builders. You want to cover that real quick before we move on?
Yeah, I kind of just skated over it a little bit. Here in the metro, in the Des Moines metro, that's like every home builder, I would say, 60% of, say they sell 1,000 homes or they sell, 1,500 homes. That's about the average here in, Des Moines. But that's a lot of homes for a large builder. And I would say a good percentage, I'm pulling it out of the air, but based on, the inventory and of all the developments that they're building, they're still focusing on the first time buyer townhome, the retired townhome, and that 300 or less, you can get a 3-bedroom, 3-car garage, brand new home. That's where they're focusing on the first time buyer. In Iowa, you can. Yeah.
Got to go to Des Moines. So people, the Californians, when you leave California, please leave California, but also go to Des Moines, Iowa. You can still get great deals.
Well, that's similar to Arkansas, but we don't have any builders that are building in that price range. We sell the resale homes in that price range a lot, but we don't see any builders there.
That's why I thought it was really
and they have basements, boys.
We don't have basements here, man. No basements here. Well, thanks for joining us and giving us kind of your take on it. That's good and interesting, and I love that you said that that's where you're focusing some of your attention for those of us who stay.
That's great. Smart idea.
But first time home buyers, we're talking about that falling. That may be a canary in the coal mine that shows it going back up if they do start buying some more in the future.
Reverse canary in the coal mine.
Is it? Yeah, kind of, I guess. So maybe sign.
If the canary is getting healthier and thriving,
it's
the reverse canary in the coal mine.
But in the meantime, most buyers feel like this whole situation is dire straits.
I want my MT. Sorry, that's dire straits.
I thought you were going like, I want my baby back, baby back, baby back. All right, home buyer sentiment falls for the 8th month in a row to an all-time low. Only 16% of those surveyed by Fannie Mae in October said it was a good time to buy a home. The percentage who said that it was not a good time to sell also fell, according to new data released Monday. Wait, the percentage who said it's a good time. Oh, sorry. The percentage who said it's a good time to sell also fell. So survey-based index measuring home buyer sentiment fell for the 8th month in a row in October to its lowest level since 2011. 5 or 6 components tracked by Fannie Mae's home purchase sentiment index fell in September to October with a record low of 16%. Consumers are increasing. This is a quote from Fannie Mae's chief economist, Doug Duncan. Consumers are increasingly pessimistic about both home buying and home selling conditions. Persistently high home prices and unfavorable mortgage rates. That's why. As continued affordability constraints reduce home buyer demand and homeowners become reluctant to sell at potentially reduced prices, we expect home sales to slow even further in the coming months, consistent with our forecast. So it goes back to something that Julie said. Where do you focus your time and energy on what you think is going to be the upswing? Where do you think you're going to pull the business from?
As a realtor, you got to kind of focus on something, right? I mean, there's got to be either your pipeline that was already there, or your favorites, right? Your past history of clients, or first time buyers. You got to focus on something right now. Something's got to generate some income.
Home purchase sentiment index. Here's the chart. Again, February of 2011, it was around 60, got down just under 60 in August of 11. We were currently 56. There's a respondent say it's a good time. It's a blank time to buy. So bad time was up to 80%. Good time was down to 16%. That's the difference of negative 64. Wow. That's pretty wild. It's a good time to sell. It's kind of converging. Respondents who say it's a good time to sell are at 42. Those who say it's a bad time to sell are at 51. So no one really knows. It's only a difference of 9.
I'll ask the same question. Does it say how many people were actually surveyed in this?
Usually there's 2,000. Let's see.
Right. Out of the 320 million plus Americans.
I'd probably have to go to the actual report to find the sampling.
Yeah. We interviewed less than 1%. Less than 0.1% of the population.
I mean, they can't survey everybody.
This is what we're going by. I mean, but you can survey 10,000 people. You can put some time into it. 2,000 people is like you just stand in front of a Costco. All right, cool. I interviewed 2,000 people in Iowa. Cool.
It was 1,000 homeowners.
Oh, that's even worse.
6 questions to 1,000, but it's a random sampling. You know, how accurate is a random sampling? It should be pretty accurate.
Of 1,000 people.
Right. Okay, so the other article comes to us from CNBC, same topic, consumer confidence in the housing market. It's a new low, according to Fannie Mae. The only additional nugget out of there was a higher share of consumers, 37%, said they expect home prices to drop in the next 12 months. That compares with 35% in September. So more and more people think that the prices are going to be dropping.
And then, Ray, I'm going to use this as a transition. I got to give you the heads up.
Oh, yep.
If everyone thinks prices are dropping, what does that do to equity?
Well, it's going to destroy it, Dan. Yeah, that's another report we have today. Here's how much equity homeowners have lost. So the woulda, shoulda, coulda solds are going to be upset about this one.
This is one since May.
Yeah. The historic run-up in home prices during the first 2 years of the pandemic gave homeowners record amounts of new home equity. Oof. Since May, however, about 1.5 trillion of that has vanished, according to Black Knight's mortgage software analytics company.
Can you recall from that fantastic brain of yours, what was the max? Wasn't it homeowners are sitting on 3.7 trillion? I'm guessing. Wasn't that it?
Oh man, I can't remember. I know for a long time they were sitting on 2 trillion, and then that went up.
It went up like crazy into the 3 trillion realm, and now it's dropped. What is it at now?
And this wasn't the total equity. This was the increase. It was like an increase of 3 trillion, an increase of 2 trillion. The total equity was somewhere around 18, I think. Maybe they'll say it. Hang on.
Crazy.
Since May, let's see, the average borrower lost $30,000 in equity. Here it is. Homeowner equity peaked at 17.6 trillion, 18 trillion. Oh. Yeah. After home prices jumped 45% since the start of the pandemic. At the end of September, prices were still up 41%, and equity was still quite strong. Borrowers who bought their homes before the pandemic collectively have 5 trillion more than they did before the pandemic. That translates to a gain of 92,000 more per borrower.
So wait, 5 trillion more than before the Rona.
Right.
But
that's where they're still sitting now
on what they've lost since May.
Yeah. While
Interesting.
additional declines may be on the horizon, homeowner positions remain broadly strong. That's Ben Grabowski, Black Knight's president of data and analytics.
Now, this is for all you agents out there. This is another thing. What do we always say, Ray? If you're thinking about buying or selling, you just got to buy or sell. Because if you were thinking about selling in, if you were thinking about selling in March this year and you didn't, you really missed out. And if you're thinking about selling in April and May, now, have they really lost the equity? Are prices down, or is it just the maximum prices are down, not home values, but what they could have potentially gotten over the last few months, right?
According to this, the pre-Pandy home value is still much lower than the post-Pandy home value. But what they could have gotten is less.
Are we out of it? Is it over?
The number of politicians that I heard talk about it this time around was super low. So I'm going to say we're out of it.
We're out of it. Okay. Officially out of it because it wasn't mentioned at the.
No one was wearing a mask on the stage this year. So I think it's over. Yeah.
It's over.
That's how you can tell. I don't know if,
We've called it here on the show. This Week in Real Estate, November, whatever day it is, November 9th, we've called it. It's over.
Yeah. No, watch there be like a Optimus Prime variation that comes out.
Oh, remember at the end of last year, Ray, that was one of my predictions. We're going to tune in on our year-end special to see if I was right, because I think I'm right, by the way.
That's funny. Uh-oh.
Good job, America. We did it.
We did it. It's over.
We banded together and we've done it. We beat Optimus Prime.
Yeah.
It's called.
So now people can feel free to move about the country. And that's just what they're doing. There's something on the magazine, Where Are Homebuyers Moving? So this is another one of those data reports. And if you guys follow NAR Research on Instagram, it's a good little account. Where are homebuyers moving? Location of homes purchased in 2017 through 2022. 2017 was about 51% in suburban subdivision areas. That was still at 51% in 2021 and went down in 2022 to 39%. Small towns grew from 20 to 29%. Let's see, what's this green line here? Rural area grew from 13 to 19%. And then resort vacation areas only grew from 3 to 4%. The one that went down the most was urban in Central City. It went down from 13 to 10% of buyers. Those two, the urban and then the suburban, went down. So I thought that was interesting. More people moved out of suburbs and into small towns. Isn't that interesting? You'd think, I don't know. That's an interesting stat to me.
I love that, by the way. People want that Americana. They want that little main street with the one stoplight. That's going by the wayside.
You Californians just think it's so cute.
Oh, I love it. I absolutely love it. Whenever I get into, like, when we were in Colorado Springs, I purposely drive off the road. There's this little town I love to go to outside of Colorado Springs. It's in the mountains. It's literally couple street, main street, and it's just absolutely beautiful. But fun fact about me, the town I'm from is just like that. There's one, it's a town over technically from where I was actually from, but Seal Beach, California, literally a main street that goes right to the beach. It goes right to a boardwalk, right to a pier, and it's fantastic.
So you'd feel right at home here in Arkansas.
I would love to live in Arkansas. I know I would. Well, specifically Little Rock. I don't know if I want to go outside too far.
So what's interesting though, with all these people moving into small towns, we had some friends do it. They sold in their neighborhood. It's a nice neighborhood they were in, but they sold in that and they moved to a small town on the outskirts. And one of the big reasons they did that was because they could work from anywhere. And when you're in the situation that you can work from anywhere, that leaves gaps. So if you and your company move out of an office building in which you formerly worked, suddenly those companies, those office buildings have way too much office space. And that's reflected. CNBC says companies still have way too much office space and they can't sell it. Let's see, a few things we know about corporate real estate, focus of cost cutting for companies, but it's probably the last asset you want to sell in a soft market. According to Elizabeth Pacek, P-T-A-C-E-K, Senior Director of Market and Analytics and Commercial Real Estate Information and Analytics Company of CoStar, There is currently 23. Hang on. Is that 23.2? No, that's 232 million square feet of surplus commercial real estate.
So
if you're thinking about looking for an office and in real estate, now would be the time because those prices got to be at all-time lows.
So I have a couple different clients I'm helping with commercial. I don't do a ton of commercial, so I want to put this question out there, but we're essentially offering whatever we want to offer. And then if they don't take it, they don't take it. There's no, we're not like when you're trying to buy a house, if you're selling a house, you have to buy another house. If you're a first-time buyer, you want to get that into that house. You want to start your new life, whatever that may be. But with what I'm, and it's a very small sampling with just 2 different clients. But what I'm noticing is that they offer and it's like, well, if they don't take it, they don't take it. We'll look for some other stuff. Is that, are other people seeing that? And I'm fine with it, because right now, if you're not getting a deal, if they're not selling, then they're making the mistake because it's not going to get any better with what'd you just say, Ray? 232
million square feet of available space. So I think, let's see, they get into it.
Or CFOs, 2 Amazon buildings.
CFO, yes. Well, it says Amazon headquarters is 8 million square feet. So
I know
they actually use that as a comparison.
Yeah.
CFOs have told us that their companies go to hybrid work and corporate hub models to make less use, if any use, of satellite offices. So there's real estate to be sold and they aren't selling it. They're holding on to it, I guess. The only property owners selling today are either those desperate for cash or they're sitting on trophy assets. And those trophy assets are few and far between. So they're holding this empty real estate. They're not selling it. I guess they're looking for tenants to fill it. Let's see. No one wants to buy assets with the risk of no demand bearing rent cuts of 50%. So they're cutting the rents.
Yeah. It's it's easy to walk away because there's a surplus right now. So there's plenty of other spaces. Now we're kind of looking for specific things. Both clients are looking for similar things. But there's plenty of things that fit this. And we're like, all right, we'll offer them this one. If not, we'll wait. And they can wait months. They don't have to be, neither of these clients have to have a spot right now. So,
well, and here's what the difference is locally for me. So if we're looking, because I'm always looking at space, there's some studio space I want to get and that kind of thing. So I'm always kind of out there looking around. And 4 years ago, I would have seen some space and gone, okay, I need to go ahead and decide today whether I want that or not, because that's probably going to go this weekend or next weekend.
Is that why? Because it's going to go, it wouldn't be available and it kind of works for me?
Yeah.
Okay.
And now I'm looking at it saying, okay, that's a space that works for me. I'll think about it for a while. And I just watch it be developed. And there's a 4 space real close to my house. Like I can almost walk to it, which would be cool. But that thing is sitting there empty and they're almost finished building it. Used to, they would have 80% full, 90% full, no room. And it's just not like that. So I know it will be. And there's smart developers and smart groups. So I know they're going to fill them up eventually.
Well, and
I feel like I can get a good deal on it. If I wait until it's finished, then they're going to be like, okay, we need to go now.
They have to. It's, they've done all this work. They have to. They can't carry that any longer. And remember when the Rona first hit and it was kind of a mass exodus. I just keep saying mass exodus. I think it does well for the algorithm.
Yeah, California.
California. When everyone was working from home and kind of businesses were shutting down, didn't we kind of speculate that some of these businesses would be picked up and kind of turned into restaurants?
Yeah, restaurants or like we talked about the malls being turned into residential, which is happening in some parts of the country.
Yeah.
Yeah, that's funny. Is anyone in Clubhouse? Or do y'all do commercial? Anybody have experience with commercial? Are you seeing some vacancies just sit there?
Yeah,
people
YouTube,
holding on to their
LinkedIn, Facebook. What are you guys thinking? What do you guys
see on the commercial aspect of it?
Yeah, my sampling is very, very small. I don't do a ton of commercial, but I will help people, obviously.
Yeah. Somebody.
Hey guys.
Hey, what's up, Jack?
Jack Attridge. How are you?
I'm good, man. Tell everybody what market you serve.
I am just a little bit north of Boston. I don't do much commercial, but I did survey 1,000 people. So
there you go. So this counts.
This counts then. What everybody say?
One of the things, I mean, you did touch on something. I mean, there's a ton of demand for housing. It sounds like we're going to have a ton of empty commercial space. I know that they're talking about it in Boston to try to convert some of the space into residential, which is needed. So thought I'd throw that out there.
That's interesting. That's one way to solve the supply issue, is to take existing buildings and convert them.
Right.
Well, and it's been a problem because there's a lot of companies that are even downsizing there's not a lot of growth out there. We're seeing people cut jobs, people let people go, and companies in the real estate market specifically, seems like they're getting worried. And we talked about them last week. We had several on the earnings. We talked about their earnings calls. We talked about one company in particular that was letting off a pretty large group of people. And the speculation that we had on last show was that they're probably doing that because they have larger than anticipated losses that'll be announced tomorrow.
And they were announced the day after the show. And we were not wrong, but this is a full-on tsunami. Like, it's bad. Like, I'm a glass half full guy, but it's bad.
Yeah, there's numbers do not lie. So the company we're talking about is OpenDoor. And I guess the question is this going to be complete game over for iBuyers? That's pretty good. Get it, game over, because that's what happens in Street Fighter.
As Ray gets into this, before he actually hits the number, if you do not know, if you already know how much OpenDoor, I'll give it away, lost. Go ahead, guess. Just guess how much they lost in the comments. Go ahead.
Just guess in your head. You're running down the street. You're listening to this news podcast because it's your long run on a Saturday. Fine. Guess in your head, how much could they lose? That would be astounding. 10 million, 50 million would be huge. These companies regularly lose like 200 or 300 million. So like a 700 million loss would be absolutely catastrophic for most companies in that situation. But wait, there's more. OpenDoor lost $1 billion. $1 billion.
Okay, let's nearly, Ray.
Okay. Sorry. $928 million. That means that given the time, by the time we're covering this a week later, they're at $1 billion of losses unless they somehow stop the patient from bleeding out on the table in 1 week.
I mean, $1 billion. We've never reported. Olivier says 1 billion is pocket change.
It's not for them.
I don't think, because we have more of these Q3 reports we're going to cover here, and it's literally a hemorrhaging. But a billion. Now Ray's I think he's gonna hit the numbers here, kind of, because they imagine more revenue, right?
Let's just imagine if somebody makes $100,000 a year. Okay, we're there. You make $100,000 a year.
Yeah.
And you lost $33,000. That's what they did. They made about 3.4 billion.
Right.
Up 50%. But they lost 928 million. They lost a third.
Billion.
Yeah. A third of what they made, they lost. So they lost all of what they made plus a third more. So 130% loss. That's crazy. That's crazy.
That's crazy, Ray. Like, that's
crazy. Crazy boys.
Crazy business.
Crazy. What is that from? Crazy. It's so crazy.
Crazy girl. You're crazy.
I think that's an SNL skit, but about Michael Jackson.
Maybe, but it's an audio on TikTok and Reels. That's where I've heard it.
Oh, is it?
Yeah, you're crazy girl.
Anyway. Over the last few months, OpenDoor has been scrambling to save cash, most recently disclosing that it would lay off about 18% of its workforce, or about 550 people. On Thursday's earnings call, CEO Eric Wu said that the necessary
not very woo right now
from long-term
right health. Now he's Eric Whoa.
Yeah. We do not feel capital is constrained, Wheeler said on the call, but the firm losses are creeping up from the firm's balance sheet. OpenDoor has about $1.5 billion in cash in the third quarter.
Not anymore.
So they can pay it. It was revealed in September that OpenDoor was selling homes at a loss. OpenDoor stuck to iBuying. Didn't they partner with Zillow?
They partnered with Zillow. And by the way, they didn't. How'd you say it, Ray? They disclosed that they were selling homes at a loss. Now, we were talking about that on the show way before they ever disclosed it. They actually admitted it. We were talking about that way before.
Our people, you guys were talking about, you commenters were like, they're selling homes at a loss. And you were talking about it for about a year before they said anything public.
And this was in every single market that we cover here, which is the world, because we're worldwide famous. Mm-hmm. What every market was saying, dude, they were like, I don't understand, because I've seen it a ton here. And I was bringing up houses, pretty much weekly. I saw another one. They bought it for this. And then they did the same thing. They dropped it roughly 5 to 7% every week until they actually sold it. But it was still less than what they bought it for.
Well, and I don't think nobody's commenting except for Olivier.
Yeah.
That's wild. Okay.
It is wild. But I don't have a degree in business, but I can pretty much guarantee that's not a great business model to buy it more than you sell it for.
The degree in business they need is a 180-degree turnaround, just like Redfin. So Redfin also made the news. They're shuttering their iBuying business, and they lay off 13% of their staff. This article was just updated. I think we already talked about that some last week, but it was updated to show that it's taken out their iBuying.
Wait, what?
Closing our iBuying business, Redfin now, because maintaining profit with rising interest rates would make offers on homes insultingly low.
Wait, though, I have a question.
Yeah.
Wasn't this the part of their business that would always be making them money?
They
by their reports. By their reports.
Yeah.
And so, now they're shutting it down.
But let's analyze this quote, because I think this is a perfect quote for you guys to put in your script books for one day when the market does return. He says, we're closing our iBuying business, Redfin now, because maintaining a profit with rising rates would make our offers on homes insultingly low. As if they weren't insultingly low had the seller been educated on what they could have sold their home for without iBuying. The problem was the education of the seller. It sounded like a good offer because it was kind of matchy-matchy with things like their estimate. But what the real estate agent knew is that seller could sell their home for a lot more. So it should have been insultingly low from the jump. But it didn't look like that on paper because of the perception of the seller. Now the perception of the seller is aspirational sell price. The reality is under that. The iBuyer is way under that because they're investors. Did they just admit?
He just admitted.
We're closing our iBuying business, Redfin now, because maintaining a profit with rising interest rates would make our offers on homes insultingly low. That's a spokesperson. To prosper in a housing downturn that could last through 2023, we have to simplify our business.
We have to. Now, Ray, are these from where are these articles in case people want to see this quote? Inman and Real Deal?
This one is on the Real Deal. We have another one on, did I put them both in there? I think
so.
Yeah. Another one is on Inman. But the one on Inman is a little bit different. It goes from the analyst point of view, and it says Redfin is called fundamentally flawed by analysts amid stock market havoc. I do want to point out the art at the top of the article they used was the Hindenburg.
That's
the Hindenburg blowing up. Yeah, is the art that they used at the top. Amid a brutal day for real estate that saw many companies' share prices plummet to new all-time lows, an analyst downgraded Redfin stock and said that the online brokerage model is fundamentally flawed. Redfin's share price dropped to as low as $3.32, a record for the company.
Wow.
It's looking
and there's
bleak on them.
For Clubhouse, there's a graph that shows their kind of historic. It's been down historically.
Yeah,
consistently down over.
Anywhere is green. Yeah. That is Realogy. They're the highest at negative 40. They went down 42%.
Right, it's anywhere.
Compass is the pink line, purplish. It's actually a fuchsia line technically. So Compass is fuchsia. I know my purples. If there's one thing I know.
Yeah.
They're at negative 52%. Orange is OfferPad. They're at negative 58%. And black is Redfin, dotted black. And they are at negative 67.52, right there with OpenDoor in the same category.
Now, this article calls out what we've been saying forever, right? And I think two things have happened. It is fundamentally flawed. You cannot pay more than, and this isn't just because of the Rona. It became exaggerated because of the Rona. They were having to pay up like other investors, but they were overpaying because what they try to do, Ray, they wanted to corner the market and then essentially create their own comps, which is really pissed a lot of people off that they were creating a false market is what they were trying to do. Obviously didn't work. But I think what's happened, Ray, is that the veil has been removed quite a bit where people are like, because it was so fancy, right? Like this, all I have to do is tap a button and I get an offer on my home. It seems so fancy and so streamlined. But if you just took that same exact thing and put it on a We Flip Houses bill, handwritten sign on the side of the freeway, it's literally the same thing.
Exactly. Which was our point from the jump. Is that
with
everyone said iBuyers will replace real estate agents. And on this show, we said no, iBuyers are competitors for investors who flip.
Not our competitors.
Right. So, as these iBuyers exit the market, the thing I've seen of the 15 properties we currently have pending.
Is that on the both sides, buy and sell?
Yeah. 13 of them are investors. I think it's 13.
Wow. Which, okay, I didn't know that number is that high because you've been saying on the show for the last month or so that investors are kind of your focus at this point.
Yeah.
That's crazy.
And investors are our focus because investors are falling into our laps because they are no longer competing, which they weren't in Arkansas anyway.
Right.
But they were competing in other markets and now they're turning to Arkansas, but they're no longer competing with iBuyer programs and instant offers.
Yeah.
So they could come in and do what they need to, flip the property, do a good job and put it back on the market and sell it. If only there was a disruptor that made sense, that was someone that was really out to give the consumers a better service and possibly take the job away from some real estate agents, at least take their money away so they could give back more. If only there was a disruptor, surely they wouldn't be in a situation of massive losses. But Zillow also sees a revenue dip and manages to significantly trim losses. The company brought in $483 million in revenue and suffered a loss of $53 million, an improvement over Q3. I just want to read that one more time. The company brought in $483 million in revenue and suffered a loss of $53 million. Their top line revenue was $483 million, and they lost $53 million. But the good news is that's significantly better than the Q3 2021 losses of $329 million. In total, the portal giant, it's down 12% compared to the $550 million that it earned in the third quarter of 2021. But their losses were less. So they're doing a better job of managing how much they're making.
And do you think this is because they shuttered the doors on iBuying and other?
Could very well be.
Yeah.
That does increase your revenues, but it also increased their outflow. Having a well-capitalized business that provides operating cash flow gives us an advantage in navigating the choppiness of the current housing market. Zillow's management segment brought in $26 million in revenue, 63% drop from the $70 million that it generated in the third quarter. I don't know what the management, I bet the management group had a big role to play in the offer, the Zillow offers stuff. The continued wide down of Zillow offers in the third quarter this year meant that the company didn't face the challenge of continuing to buy and renovate housing in a worsened market. So again, they're not iBuying. They're partnering with OpenDoor, who will be doing the iBuying.
But
and Broke Agent Media, Byron Lazine, on his little show, I don't mean it like that. The Racket on his show. He said they were talking about it and it being the end of iBuying altogether because it doesn't look like anybody can make a profit with it.
I don't know if it'll go away. I think it'll just be It'll
It has
stay
to
in
be.
this. I mean, what was it? What did it end up being? 1% or something when you really broke down the numbers?
Yeah.
It'll just be less, but you'll just see less. There's just going to be less of a push for it out there because it was so saturated in, well, around me, obviously. Ray doesn't see it, but it's just so interesting.
I don't see it at all.
They'll just take a smaller piece of the pie. How about that?
Mike V says, not to pick on Compass, but their stock is under $2 a share today. It opened with a high of over $22 a share. That's interesting. So if you're a Compass believer, go buy some stock. But we don't give investment advice.
Yeah, understand that.
We don't give investment advice.
What's a bottom? What's a rock bottom with stocks like that?
$0, I guess.
So zero.
You have to pay them.
I know. What if
you call and you gotta just pay them money?
Yeah.
You know
that's their play. They're gonna get people to pay them.
I lost our rundown for a second. There it is. Okay, so we have one more company to cover. That's interesting. They're kind of a newer player, I guess you could say. They've been around the block a bit, but they're also not doing so hot. And we made fun of Homelight for raising how much they charge real estate agents. We made fun of Anywhere because they also talked about all of the things under them, which are Century 21, Coldwell Banker, is it Sotheby's? No. Yeah.
Sotheby's, and then they have
Better Homes and Gardens.
Yeah.
And Cochrane. So Anywhere said, hey, we're going to have to start taking more money from real estate agents probably. And I feel like they're like floating that out there to see how agents respond. So I actually told some of my friends in those companies, I was like, hey, you like got to stand up and, raise your, what's it called? Rattle the sabers and let them know that this is not good. So you can keep more of your money. But we have another company kind of doing the same thing, going after real estate agents, Fathom, which are they in your market, Dan?
No, I had never heard of them.
Okay. Fathom raises transaction fees, boosts incentives among Q3 loss. So they're another one that came in as a quote unquote tech platform that's just really just trying to reduce fees. The real estate broker and tech platform is accelerating the cost cutting after posting a $6 million third quarter loss with revenue up. So they gained revenue 10.2% and lost $6 million. Their agent count is also up. And we dealt with this with Anywhere. We talked about how they had a huge increase in agent count and yet they had huge losses. It's crazy.
So that's the thing, right? And I think we mentioned it in the contributors group, which is right. And I predict right now that these types of companies are going to get an influx of agents. They are, because it's cheaper. Like, and I don't know what Fathom offers, but the graphic that Melissa sent was, it was a comparison to a traditional, quote unquote, traditional real estate where you have to give up 30% of your commission. Right. And then Fathom said all you have to do is pay the $500 flat fee, which it's really not, because they'll charge desk fees, they'll charge operational fees, they'll charge website fees, all that stuff. But anyway, whatever, let's say it's $500. On the surface, it looks like it's a pretty good deal. So I think a lot of agents that are going to be doing a lot less business right now are going to go to these brokerages. So I think
the ones who do less business will go to the flat fee. I just quickly did my year to date.
Yeah.
Closing 60 transactions at $500 a transaction is $30,000, which instead where I am, I'm getting paid $12,000. That's a difference.
Yeah. Well, and then you have like when you go to real estate companies where you cap, you would have more than capped, right? Like at whatever, Keller Williams or whatever, you would more than capped and gone to 100%. And bigger agents who cap, or they pay off their cap at the beginning of the year, whatever it is, 17 to 26 grand, depending on the market, they pay it off. Then they literally make 100% all year, except for the desk fees and the office fees and things like that. But I'm predicting.
It always sounds, I think you're right. I think the ones that do a small number of transactions that don't really want to mess with the desk fees, they don't want to go into the office. They're just looking for a discount situation. I think this is attractive to them, but also those could be the ones that cost you the most money.
Right. Because there's no coaching there. There's no mentorships there. There's no support. I don't even know if they can have a broker conversation. I don't even know if they're going to know who their broker is. So in the long run, I don't think it's necessarily going to hurt the agent. They're going to still do their normal-ish transactions a year. And then maybe they make more money and they're happy about it, right? But what it's going to hurt is that company's number. And I'm not just saying Fathom. I'm saying these types of companies. It's going to hurt their overall numbers because they're going to have agents that don't do a lot of business and then went there just to save money. And then there's also another company out there that promises that you're going to make a lot of money off of recruiting. They're going to get hurt as well. And then we're going to see more losses, and it's going to hurt overall who at the end of the day? The client.
Yeah. And we talked about this in the in our Be More chat, the contributor chat that we have. And I think the common thread is that companies that take everyone, they're going to have a hard time through the downturn because they're going to have to train, they're going to have to keep up with. It's a lot to manage. They also have to keep their booty out of legal trouble. If you take anyone, you risk sacrificing your culture. And if you don't have the culture to lift up everyone, then it's all going to be on leadership to do it. Leadership is the one that has to do it.
Like if I'm going to put my faith in anyone, I would go to Compass, because Compass doesn't just take anyone. I don't know
now. They didn't originally, but they do.
They might now, but every Compass agent I've ever worked with is legit. They know their stuff. They know how to sell a house. They know how to help buyers, depending at whatever side I was on. And again, and I work with a lot of them in the LA area. They have a big market share there. It might be less now, but I would put some faith in them. That
I would say that the Compass agents, for the most part, have a culture of excellence.
Yeah,
everyone I have great friends that are at Compass, and I love and respect them. I think they're incredible. Their company is just mismanaging funds.
But that's different, and how that's different from the actual agents, and that's different than how they got those agents. It might have been shady at the beginning, right? But I would still put faith in them, and they also expect. It's not the culture of excellence. They expect that, they're all very similar, how they work and how they run. It's all clean. It's all crisp. They're very respectful to other agents, again, in my experience, and they expect it. And I think that's going to serve better for the company. And then, for their clients in the long run. That's my kind of prediction.
Yeah. I would agree with that. I think companies that stick to it, it's really hard to stick to it in the long run. But I think if you stick to having a solid culture, then you're going to be fine. But as soon as you start to just let anyone in that can breathe, and they may or may not be a culture fit, and they may or may not be good, and they may or may not listen to your broker, and they may or may not keep you out of legal trouble, that's when the issues are going to arise.
That's
and
kind of a big one at the end there.
Especially in a market in which commissions are compressed and there's fewer inventory to sell, there's less buyers in the marketplace, there's less business to go around. You're going to have some agents that get a little bit catty about the whole situation. So it's going to be really important to align with the right people more than ever, perhaps. And speaking of aligning with the right people, Dan, would you tell people where they could find you?
Yeah, Ray, you have to take a different tone now. After all the doom and gloom and losing billions of dollars, go find me on Instagram at dludwigrocks, DLUDWIGROCKS, and get a positive take, not always, on real estate. Because I love real estate agents. I can't do it, Ray. I'm trying. I can't do it. Go get a fun take on real estate for me, because real estate is boring as all get out. Ray, where can they see you?
You can find me at Ray Zorback. That's RAYZORBACK. Everywhere good Razorbacks are sold, mainly on Instagram. Just follow me there. Send us a DM. Let us know that you listened to the show. There were a couple of people that DM'd me last time. They're like, hey, man, just wanted you to know I'm a long-time listener on the podcast. I make it to the end of the show. You said to let you know. They sent me a message and let me know. So we really appreciate that. That means a lot to us. Thank you guys for participating. And we will see y'all next week. Bye, everybody.
Love you guys. Go check on your friends. Go make sure they're okay. Love you guys.